Hi everyone, my name is James Kinghorn. I'm one of the portfolio managers for the global equities team at Nikko Asset Management, and I'm going to be presenting the third quarter global equity portfolio update for 2021. So what I'd like to do, I'm going to briefly run through some of the key concerns many investors have today, what we've been doing in the fund over the last 3 months, how we're positioned today, and I'm also going to have a quick spotlight on a couple of names in the financial sector that we hold. And this is a sector, along with energy, that has been a very strong performer in the last quarter, and actually most of this year. But first, let's just recap on what markets have done over the course of 2021. So despite a lot of concerns from investors, particularly around lockdowns, the pandemic, supply chain issues, employment shortages as well, and the threat of inflation, the markets have been particularly strong, albeit with the odd correction throughout the year, which is perfectly normal. But this is because some of the concerns that we've mentioned have weighed on sentiment. And we can see in the final month of the quarter in September, quite a steep correction as these concerns really sort of came to the fore. But the markets rallied back very strongly near all-time highs during the course of October. So moving on to the next slide, it's just looking at the performance between value and growth. And the reason I put this up here is because it's actually been a constant debate, I think, amongst a lot of investors about where to position themselves from a stylistic point of view, value or growth. And we can see value performed significantly better, at least in the first few months of this year as economies started to open up. And many of the companies that were considered lockdown losers started to perform very well as countries lifted restrictions. But this stalled early in the year, and you can see that growth made a bit of a comeback. Value sort of flatlined to some extent, and this is largely a function of the Delta variant, which delayed reopenings for most regions. And actually, where we stand today, the performance between the two is almost identical. So looking at this a slightly different way on the next slide, we can see the performance of cyclicals as defined by MSCI versus defensives, again, as defined by MSCI. Now, both have been very strong year to date. However, the difference is far more marked between versus value and growth that we saw in the previous slide. And actually, cyclicals have performed significantly better right through the end of October. And this is really a function of the makeup of the index, and it's driven by the IT and financial sector that make up a significant chunk of the cyclical index. Now, the strong performance across all these industries, as I mentioned at the beginning, has been despite what we'd call a wall of worry. Now I've listed a few here, but the fact is they're all interlinked. Now there are concerns over rising commodity prices, concerns over broader inflationary pressures in the economy, as supply disruptions, all as a result of the pandemic and as a result of the employment shortages that we've talked about. And there's been a long-running debate, and this has been going on not just in 2021, or certainly not just in this quarter, over the valuation of the market. So on the next slide, we can see some of these inflationary pressures. On the left-hand side, we can see the spike in gas prices, for example, in the black line, which has shot up meaningfully during this latter part of this year. And then also rising food inflation on the red line, which has been actually rising for several months now since the middle of 2020. And then on the right-hand side, this is the Baltic Dry Index, which just gives an indication of spiking transport costs, which we've experienced again during the pandemic because of the bottlenecks and for many other reasons. But periods of inflation post a shock to the economy, and shocks can be wars or pandemics. Typically, there has been a spike in inflation as demand has rebounded sharply, but supply chains have typically been disrupted either by underinvestment, shutdowns, and then certainly in the case today, a low labour participation. So there's simply not enough employees for many of the required jobs. And so the supply side of the equation just hasn't normalized. Now, we're not trying to forecast when these headwinds abate, how long inflationary pressures will last. But what we do is try and identify companies that have the right pricing power, that can pass on costs to customers, and that have a defensible moat, i.e. that can protect themselves from these challenges, regardless of how long they may last. And just as importantly, we try and buy these companies at the right price. So on the next slide, we've got a couple of charts here that look at market valuations, and we think some parts of the market look very extended, less so in other parts. So on the left-hand side, we can see valuations of large cap growth companies, i.e. the fastest growing companies in the market. And we think this highlights that many of these stocks are extended. In fact, this basket has only been more expensive once in the last 50 years, which was during the tech bubble in 2000, as we can see in the chart there. And a lot of these names in this index are relatively recent, relatively new companies, relatively new to the market, and many of them are loss-making. So while the top line is growing rapidly, we think that the path to future profitability, and particularly rising returns on invested capital, is far less clear. But on the right-hand side of the slide, we're looking at the valuation of the broader market versus bond yields. And on this basis, valuations look far more sensible, albeit that there is question marks about where the bond yield is going as well. So I think this just highlights that investors more than ever need to be very selective when identifying opportunities, and we are particularly cautious, as I said, on that first group of companies that are the highest growth companies, and particularly loss-making companies within that basket. Our philosophy is, and always has been, to identify companies that can attain and sustain high returns on invested capital over the long term. And we believe that these companies will companies that can consistently deliver strong returns and or improve returns on invested capital over time can outperform the market over the long term. So in the last, maybe just jump to the next slide. In the last 3 months, just highlight some of the changes we've made to the portfolio. So we took a new position in positions in 3 new companies. First is Masimo, a US medical technology company. Also TSMC, the Taiwanese semiconductor company, and Emerson Electric, which is a US industrial. And we funded these by selling complete sales of LabCorp, Johnson Matthey, and Unilever, as you can see. And we also made some modest additions and reductions to existing holdings just based on our valuation discipline. So, and then this shows our portfolio as a whole. So this is all our names here, and we'll put them in this presentation into three different buckets. And really to highlight that there were a number of companies and business models that really benefited from the pandemic due to some of the accelerations in the adoptions of new technologies and services. And we continue to hold them, and these are highlighted on the left-hand circle on the chart. But on the margin, we've really been reducing exposure to some of these. They've performed very, very well. And we've been investing into the other 2 buckets. We've been investing into companies that we expect to benefit from the opening of markets who have perhaps struggled during the pandemic, but will benefit as the economies open up and win share, we believe. But we also have a significant exposure to the third circle there on the right, the green circle. About 34% of our portfolio is invested in these companies, and these are names that provide social and environmental solutions to some of the world's problems. And we think this is a very long-term theme for our fund, and something that can, and a theme that will run for many years or even decades. Now, I just briefly want to touch on the financial sector before I finish. This chart on the right, on the right, yeah, shows highlights how weak the sector has been. This is a 5-year chart that shows the relative performance of financials to the broader index, and as we can see, it's underperformed for several years, but it has rebounded strongly through 2021, largely on the prospect of rising interest rates. And the left-hand charts here, and the blue shows our exposure to the financial sector over the last 5 years. And we've consistently had a meaningful weight in the sector, and currently around 16% of our portfolio is invested in the financial sector. Now, our approach to investing here is the same as it is for every sector that we invest in, is really to identify companies that have differentiated business models, defensible competitive advantages, and those that will improve the returns on capital over time. The next slide shows our average exposure to each sector. This is since inception, but also our excess return or alpha from each sector, and this is highlighted in the green circle. And you can see that we've added alpha over the last 7 years across a broad range of sectors, very diversified alpha, and we haven't relied on one specific sector or geography to drive performance for the fund. So with that, I just wanted to talk briefly about a couple of names that we hold. The first here, as you can see, is Silicon Valley Bank. This is a US regional bank, but is focused on banking the innovation economy. So they bank startup companies primarily in the IT and healthcare sector, as well as banking the private equity and venture capital companies that fund these startups as well. And we think they've created a really strong competitive moat. They have what they call an innovation ecosystem, and I think it's really hard for other banks to really enter that space aggressively, given their position and their scale now. The environment for startups has obviously been very strong for the last few years. But there is still a significant amount of capital, dry powder, with the private equity and venture capital companies that we think will be put to work over the next decade or so. And Silicon Valley is very well positioned to benefit from this environment for many years to come. And the last name just wanted to highlight is Palomar, which is a US property and casualty company. It's actually a very new company. It formed in 2014, and it's focused on disrupting niche lines of business in the US P&C market, just through the use of technology and data. So it's really an insurtech company. The largest business they have, as you can see on the right of the chart there, is the earthquake business, and they've been winning share consistently in this market since they entered it a few years ago, just by providing more granular and efficient pricing with the use of their data and technology. And they've also entered several other new markets, which they believe they can disrupt in exactly the same way. And what we also like about them is that they protect returns for shareholders by having a very comprehensive reinsurance process. And we think they can sustain over the next few years. We really think they can sustain very high top line growth, 20 to 30%, as they introduce new products and expand their distribution over the next few years. And then just very briefly, as here's the performance of the fund since inception. You can see on the left-hand side there, and then on the right-hand side is the annualized performance over 1, 3, and 5 years since inception as well. So that's the end of the formal presentation. I just want to thank you very much for listening to me and for your time today, and we look forward to updating you next quarter. Thank you very much.